Hello people, let's continue our discussion on marathon, and next we are taking accounting standard 2 that talks about inventory ka valuation. Sir, inventory are of three types, though they are raw material, work in progress, finished goods. So if you want to assess it on the definition side, AS2 says inventories are those goods which are held for sale in the ordinary course of business, which you will sell in the ordinary course of business. Raw material, WIP, or finished goods. Finished goods, or in the process of production of such sale, meaning something which is in the process, something which is in the process, we call it as work in progress, or raw material to be consumed for manufacturing process or production process. That is your raw material inventory. So inventory could be one of these three components. Now, if you have any construction contract related inventories, right, they are not accounted as per AS2, it is accounted as per accounting standard 7 itself. So if you are a builder and if you have any buildings and all, they are valued as per accounting standard 7 and not as per accounting standard 2. That's one. If you are, this has come one or two times, if you are producers, if producers inventory of agricultural produce, mineral ores, forest produce and all, they are not measured at cost or NRV, whichever is lower, but rather directly measured at net realizable. That the keyword there is not retailer, not wholesaler. The keyword there is producer. Meaning if there is a farmer, if he grows any agricultural produce, in fact, go one step back. You know this already. How is inventory valued? Inventory is valued at cost or NRV, whichever is lower. This is the basis of inventory valuation. But if you are a producer of agricultural produce, meaning if you are a farmer, you don't have to measure your inventory at cost or NRV. Directly you can measure it at NRV. Okay, people, that's the thing. And same holds good for your forest produce, mineral ores also. Okay, as we have discussed this, overall inventory should be valued at cost or NRV, whichever is lower. For cost purpose, you can categorize it into maybe, like I would say, three things. Cost for this purpose can be categorized into three things. One is purchase cost, or you can call it as net purchase cost, conversion cost, and any other cost incurred to bring the inventory to the present location and condition. Net purchase cost, conversion cost, any other cost incurred to bring the inventory to present location and condition. This you already know. There's nothing but your DAC. There they called it as DAC. Here they are calling it as present location and condition. Meaning till the time, because inventory you don't use, no. Because in DAC we said they are those costs incurred to make the asset management ready to use. Inventory you use or you sell. So that is what they mean by here. Present location means your factory. Till the time your goods reaches your factory, whatever related cost you have incurred, like transportation cost, you can add. Loading charges, unloading charges and all you can add. And condition here refers to usable condition or sellable condition. This inventory you will use or you will sell. Till the time inventory reaches sellable condition, whatever related cost you are incurring, you can add. It is the concept is same as what DAC. Done now, people. So this is your purchase cost, this is your DAC. Another one that have been brought in here is the conversion cost. Conversion cost is only relevant for the manufacturer. Because manufacturers don't buy the finished products, they buy what? Raw material and convert that into finished goods. To convert raw material into finished goods, they will have to incur some cost. That cost is what we refer to here as conversion cost. Yes, no, people? Because unless the raw material gets converted into finished goods, will the person sell that goods or they will not sell? So in order to make or in order to reach sellable condition, conversion cost is also necessary. So hence these are broadly the cost for inventory valuation purpose. And purchase cost also, you know what can come under purchase cost, same as AS 10 and 26. Tell me. Purchase cost. And then if you have any non-refundable taxes, add. If you have any non-import duty, non-refundable taxes, add it. If you have any rebates and trade discounts, reduce. That way you will get your net purchase cost. DAC also, we already know. Some example could be loading charges, unloading charges, your transportation charges, all that will come under this category. Conversion cost, if you want, you can further segregate it into 4 components. Conversion cost can be further segregated into 4 components: direct material, direct labor, variable production overheads, fixed production overheads. Okay, all these are added on an actual basis. All these 3 are added on a actual basis, meaning if you have incurred 1 lakh worth of raw material cost, at 1 lakh straight away can be added to the cost of inventory. If you have incurred 50,000 worth of labor cost, straight away it can be added. Variable production cost also can be straight away added. But for fixed production overhead, there is a small calculation. Anybody remembers? Fixed production overhead, there is a small calculation. What is it? Normal capacity or actual capacity, whichever is higher. Fixed production overhead ka absorption is based on normal capacity or actual capacity, whichever is higher. This I gave you calculator example if you remember in class why it is. I'll not go into the logic, but that's how you go for the absorption. Maybe one question we will take if time permits to kind of understand this little better. Done now. So all these 3, whatever is given to you in the question, straight away add. For this alone, you will have to calculate by keeping 2 components: normal capacity and actual capacity. Okay. So that is 1 no. Okay. And how do you get net realizable value? So name is not saying realizable value. It is saying net realizable value. How do you get NRV? Sale value minus selling expense minus further completion cost, if any. NRV ka breakup is sale price minus selling expense like your salesman's commission, etc., minus further completion cost, if any. Sir, this further completion cost is only relevant for WIP because finished goods is already complete. What more you will incur? The further production cost you will incur only for WIP, because WIP means it is neither raw material nor it is finished goods. It is stuck somewhere in between. So that only for WIP, this component will come into picture and not for the other things. This is the basis of your valuation. Any doubt till here? No, all okay? All right. Next to is joint product. Joint product means you are producing multiple products by incurring one cost. You are incurring a common cost, but you are producing multiple products. That we call it as joint production. Like if you have 3 products, is it necessary you have to buy 3 machineries? Is it necessary you have to hire separate workers? Or can one machinery only produce 3 products? Possible? It's possible, right? One machinery may have the capability to produce 3 different types of product. One worker only can work for production of all the 3 products also. Yes or no? If you remember, I used to give Arvind example in our class. Arvind Mills, right? Okay, I think I'll stick to this. Otherwise, somewhere else it will go. So, look at this over here. A company is producing 3 products. All are separate. 3 products are A, B, and C. But is it necessary you have to buy 3 machineries, 3 workers, separate set of workers, or can you have one set of people? You can have one set of people who are helping you to produce all the 3 products. Yes, no? Okay, but here the problem will arise. What is that? Let's say, sir, I incurred 10 lakh. But this 10 lakh is a cost, is definitely the cost. Is it the cost for one product or 3 products? This cost, what I've assumed to have incurred of 10 lakh is not for one product. It is for 3 products. But inventory A is different from inventory B, which is different from inventory C. And what does AS2 say? What does accounting standard 2 say? Each inventory should be valued at cost or NRV, whichever is lower. Can you tell me what is the cost of product A? This inventory, can you tell me what is the cost? Do we have separate cost or it is a common cost? I have incurred one cost to produce multiple products. So this concept is what we refer to as joint products. So we are incurring one cost and producing multiple products. But for inventory valuation purpose, I need to know the cost of each inventory. So how do we allocate this 10 lakh among the products? That's the question that got raised. Standard recommended few things. One, you use sale value. You use a sale value ratio and allocate 10 lakh among 3 products. All the 3 products you will sell, no? So in the sales ratio, you can allocate it. or you can allocate it in the cost ratio or number of units produced ratio. You can use any rational and consistent basis. That's what AS2 says. Use any basis, but don't keep changing the basis every year. First year you'll allocate based on sale. Second year I'll allocate based on number of production. Don't do that. Use one basis and follow that. Okay. For exam purpose, they will give you the sale value. Let's say they will give the sale value. Let's say sale value is A is 15 lakh, this is 17 lakh, and this is 20 lakh. So what you will do? This 10 lakh you will allocate in what ratio? 15 is to 17 is to 20. That's it. That way you will get the cost of all the three products, that is A, B and C. Compare that cost with NRV and you will be able to value the inventory. As simple as that. Okay, G. Next one. Okay, byproduct. Byproduct is bumper, bonanza. You want to produce one product, you got another one for free. Now Rashid sir is going to come and teach costing for you now in another 15 minutes. You wanted accounts, so you are also getting a costing. So that is your byproduct. Hey, just kidding. Yeah, they're like excited. Look at me. They're seeing me off. Okay. So now byproduct means your intention is to produce one product, but you're getting another one for free. So such scenario or such concept, we call it as byproduct. Okay. Now what you have to do for this byproduct is, sir, usually, so it's a 1+1 offer. Can I say that? You want to produce this main product called 1, but you're getting another extra called byproduct. But usually you will not be that lucky. You will not be so lucky that this byproduct ka value will be very high. Usually the value of this byproduct will be very minimal. So what the standard says is, since that byproduct ka value is not so high, you simply, what you do is, you find out net realizable value of this byproduct. You find a net realizable value of this byproduct. Let's say it is 1 lakh rupees. But in order to produce this, let's say you incurred 15 lakh rupees. In order to produce this, totally how much cost have you incurred? 15 lakh. What standard says is, simply find out net realizable value of the byproduct and reduce it from the cost of main product. Meaning this 1 lakh, you reduce it from 15 lakh. So how much it will become? 14. So the cost of the main product will be taken as what? 14. That's all. It's a recommendation. Okay, G. So what if byproduct ka value is very material? Then it is not a byproduct. Then it becomes joint product. That means because you have two products which has significant value, no? Then you will have to apply which concept? Joint product ka concept. I don't think so. Nobody will be that lucky. So you don't have to worry about that. So in practically for exam and all, you simply have to do this. Find out the net realizable value of the byproduct and what? Reduce or deduct it from the cost of main product, and accordingly go ahead with the calculations. Sir, so far we saw cost inclusions. 3 things: net purchase cost, conversion cost, and present location and present condition ka cost. Those are inclusions. Here we are talking about exclusions. Pretty much the same as AS10. Tell me, what are those? General administrative overhead, selling and distribution overhead, any promotional expenditure, even storage cost also is excluded. Because the funda is what, sir? The keyword there is present location and condition. Location here means what? Where is that? Location here means what? Our factory. Condition here means what? Sellable condition. Correct? No. Now, when will you store the finished product? After it is ready to sell. After it is ready to sell only you will store. I mean, this present location and condition wala limit is already reached. Okay. So hence storage cost of finished goods we don't add, but transfer it off to P&L. Sir, what about storage cost of raw materials, sir? What is storage cost of WIP, sir? That you can add. Because has it reached sellable condition? Has raw material reached sellable condition? No. Has work in progress reached sellable condition? No. And storage cost of raw material and WIP you can add, but storage cost of finished goods you cannot add. So how do we know whether it is storage cost of WIP, raw material, or work in progress? If question simply says storage cost, always assume it is storage cost of finished goods. Only if they mention storage cost of raw material, WIP, then only add. Otherwise, always say it's excluded. No logic, just the way ICAI solution works. I've seen few solutions. That's the way they are interpreting. So let's interpret the same for the sake of money ala marks. Actually, money and marks one and the same. No? Yeah. Okay. Yeah. All right. So these are all some exclusions. So, what done? Okay. Next, sir. For PP and all, no, cost is pretty straightforward. Because, sir, at best what, sir, you may buy 2-3 assets. But inventory, no, sir, you will buy thousands of times. Possible, no? Like every day you may buy 10 to 15 times, maybe hundreds of times. So cost will be same or it will keep changing? It will keep changing. So is it easy to keep a track of that? No. Hence they suggested a shortcut method. That shortcut method only you have learned it as FIFO, LIFO, blah, 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 FOFO. Okay, G. That is a simple, that in AS2 terminology, we call it as cost formula. Since cost keep changing, it becomes a little difficult to track. Hence, they have suggested a shortcut method to find out that cost. Either you can use FIFO or you can use weighted average. Predominantly, many of the organizations go for weighted average. But there are other methods also applicable like standard costing, retail and all. But for our exams, mostly it will be, well, they'll not ask such questions. Mostly they'll ask all this in foundation. Inter-level may highly doubtful, but it can come. And we have done. Don't ask me to solve FIFO, LIFO and all. No, that I think you can manage. Okay, na? All right. If you have forgotten, go open your CA foundation book. So you will get it there. But rare. Such questions are very, very rare. Sometimes it comes. Okay. All right. Now people, sir, there's one more called specific identification method. What is that? Sir, before you talk about cost formula, no, you need to check are inventories same or different. If you have, let's say, two types of products you have, A and B. If A and B, if they are similar, okay, if A and B are same, okay, then you can either go for FIFO, weighted average, standard costing, whatever. Any of these three you can use. If A and B can be substituted, whether you buy A or like this. Let's say there is a calculator dealer. Instead of A and B, maybe I'll use that example. Let's say there is a calculator dealer. He purchased 500 calculators. How many? 500. So is Calc number 1, Calc number 450, Calc number 497 different or same? Whether you customer buys Calc number 1 or Calc number 497, it is one and the same. That means what? Which category is this? Similar. If products are similar or substitutable or interchangeable, then you can follow any of these three methods for finding the cost. Suppose inventories are not interchangeable. Inventories are not interchangeable. Your jewelry. When you go to showroom, you will see a lot of jewelry, no? Can you say all jewelry same, all gold only? No, jewelry 1 is different from jewelry number 2. Because, I mean, you will know better in that context, right? I don't know much about jewelry, so let me not talk about that. Let's say designer clothes, customized clothes, right? Is suit number 1 same as suit number 2 or different? If it's a customized product, they are different, yes or no? For that, you will have to only use what method? Specific identification method. So what is this, sir? So if you have designer clothes, let's say you have two types of suits, we call it. Let's say S1, S2. What you will have to do is you have to find cost of S1 separately, NRV of S1 separately. Let's say cost of S1 is 1 lakh, NRV is 90, NRV is let's say 1 lakh 50,000. How will you value the inventory at? 1 lakh. Suit number 2 ka cost is 2 lakh, NRV is 3 lakh. How will you value it at? So did you add both ka cost and both ka NRV or you did separate valuation? That separate valuation only we call it as specific identification method. So if you cannot change the inventory, then each type of inventory ka cost and NRV you have to do separate comparison and do the valuation. You cannot do like this. Like here, you can't add both the cost and say cost is 3 lakh, NRV is 4.5 lakh. I will value the inventory at 3 lakh. That sort of permutation. Here maybe answer is coming same, but it did not come same in every case. You can't do this approach. You'll have to value each inventory separately. That's your specific identification method ka drama. Okay, Naji. Disclosure not that very important, so it's fine. Okay, let's go into some numbers. Okay, class notes and same thing you'll find in your ICAI study material also. Quite a popular question has come a few times. So let's see. Okay, I'll tell, there's a small concept here. I think I'll do it along with numbers. In a production process, the normal wastage is 5% of input. How much ever material you insert, 5% of that will be any which way be lost. You cannot avoid that. So it's a case of a normal loss. Okay, how many metric tons of inputs did you put in the process? 5,000 metric tons or meters you put it into a particular process. So 1 second. Sir, how much ever material you put it into the process, how much will get lost? 5%. So calculate 5,000 was the process ka material. You are expected to lose 5%. How much is it? 5,000 into 5% gives you 250. So the normal loss is how much? 250 meters or metric tons. Correct now? But what are they saying here? Check. The wastage was totally how much? 300. We expected how much? 250. But the actual total loss as given in the question is 300. That means what? In this 300 total loss, 250 is normal loss. Beyond the normal loss, whatever you're getting, that we refer to as abnormal loss. And what AS2 says is abnormal loss ka cost cannot be added to the cost of inventory. That has to be transferred to P&L. Okay? Because that is due to your failure. No? Due to your failure, we can't increase the cost of the asset. If there is a failure, means you have done something wrong. Let that loss get reflected in P&L. So don't cover it up. Hence, we say abnormal loss, you transfer it off to P&L. Don't add it to the cost of inventory. So far, these numbers are looking good. What we have calculated. Okay, going further. 1 metric tons or 1 meters costs you how much, sir? 1,000. How many meters did you insert? 5,000. So what is your total purchase cost or total raw material cost? For 1 meter, 1,000. For 5,000 meters, it will be 50 lakhs. So that means the total cost will be 50 lakhs. Anji? Okay. The entire quantity of waste is on the stock at year end. So that stock you have not disposed, it is still there. Because even that those abnormal loss also can have some value. No? You have not yet sold them, it is still lying at year end. Now state with reference to AS, how will you value the inventory in this case is what they're asking. Okay. Sir, there is a small concept of normal loss versus abnormal loss. What we say is normal loss will be absorbed by the good units. Those of you who have done costing, I think this terminology will be used across. Okay, normal loss will be absorbed by the remaining good units, we say. But abnormal loss, or maybe I'll write one more point. Whenever there is a normal loss, quantity will reduce, cost or selling price per unit will increase. These are the 3 things which will happen whenever a normal loss comes into picture. Okay. In fact, if you remember, I used to give some apple or mango example here. Apple, okay. This time we'll make it apple. Okay, maybe just in the context of question, I'll quickly explain this. Sir, let's say I gave you one assignment. I am an apple dealer. Okay, I'm a apple dealer. I have 20 apples. Okay. And I told you, okay, sell it at 50 rupees and get me 1,000 rupees. I gave you all 20 apples, okay, and told sell it at how much? 50. If you're feeling bad, I'll make the number big, or it's okay now. And 20 is enough for you. Okay. All right. So I gave you 20 apples and I told sell it at how much? 50 rupees per unit, and totally you have to pay me how much? 1,000. So why will we sell, sir? I'll give you commission. Don't go into that now. So far, okay na? But you were busy in marathon class. You are busy in marathon class. So you forgot about apples. You forgot about apples. So red color apple has become black color. Red apple has become black color. 50% of the apple has got rotten. 50% because you forgot to keep it in fridge or whatever. You were busy, papa. So much commitment you have, studies, oh girlfriend, oh boyfriend, so much, huh? So you were busy, the 50% apple, what? Oh, gone. Go in there. How much remains? 10. But I have given you clear instruction. What is that instruction? Boss, you do whatever you want. I want 1,000 rupees. I want 1,000 rupees. Now you are Brahaspatis, smarty pants. What did you do? You calculated. Anyway, this guy wants what? 1,000 rupees. Now you have to give me 1,000 rupees and you have 10 apples. So you used your kidney and decided to sell the apple at 100 per apple. Correct? No? Yes, no. Normal loss concept. Normal loss concept. Now, in check. Sir, 50% of the apple has got rotten, but still, is there any loss or it has got absorbed? Because see, here also 1,000, end result may here also 1,000. Yes, no. So that is what we mean by whenever there is a normal loss, in reality you are not suffering loss because it has been absorbed by which unit? Other good units. 10 apples got rotten, no. But the 10 apple ka loss is absorbed by other good 10 apples. That's the reason end result may there is loss or no loss? No loss. This is the overall concept of normal loss. Whenever normal loss comes into picture, two things compulsorily will happen. Quantity will reduce. How many apples you had before? 20. How much you have now? 10. That means what happened to quantity? Reduce. Correct? And price or cost per unit will increase. How much initially you wanted to sell it at? What was the cost per unit initially? 50. Now it became 100. The cost of the selling price per unit will increase. Okay, G. That's all it is. But in reality, is there any loss or fully absorbed? Fully absorbed. Okay. We just have to apply this in this concept. Can we do so? Okay, now come back to this concept. This question. How much is your purchase cost? How much is your purchase cost? 50 lakhs. How much is the normal loss expected? 250. How many meters did you insert? 5,000. How much anyway will be lost? 250. What is remaining good units? Expected. What is the remaining good units? In 5,000 mein 250 is loss, normal loss. So what is the remaining good units expected? 4750. That means this 50 lakh will not be absorbed by 5,000 units. It will be absorbed by remaining good units of 4750. Yes, sir, people. That's what we just now said. Now, how 4750? We inserted how many meters? 5,000. How much normal loss quantity you lost? 250. So remaining good units is how much? Remaining good unit expected is how much? 4750. So this 50 lakh of cost will be absorbed by 4750 good units expected. Easy now. That means for 1 unit, how much is the cost now? 50 lakh will be absorbed by 4750 units. So for 1 unit, how much? 50 lakh divided by 4750, which is 1052.63. Again, if you want, you can retest your concept. In normal loss, two things will happen. What is it? Quantity will reduce. How many meters of product did you insert? 5,000. Now, how much good units is remaining? 4750. So, quantity reduce. Second concept. Price will increase. How much was the cost per metric tons before? 1,000. Now, how much it has become? 1,050. That's increased. Yes, Aji. Correct, Aji. Pakka na Ji. Okay, till here we are good. But hang on. This is only the concept of what? Normal loss. But there is also here abnormal loss. Abnormal loss is your fault. That cannot be added to cost of inventory. That has to be transferred to P&L. Now, how many meters did you really lose? 300. So, totally you lost 300. In this 300, how much was normal loss? 250. Abnormal is how much? 50. So, abnormal 50 units you have, no. That cannot be absorbed in inventory, but it has to be transferred to P&L. This is how much quantity? 50. And what is the cost per unit? 150. So add, multiply, what is the total cost related to abnormal loss? For 1 unit, 1052.63. For 50 units, how much? 52,630. That is abnormal loss which will get transferred to P&L. Clear? How much inventory you actually have now? Don't say 4750. How much inventory you actually have? Though you inserted 5,000 meters, totally you lost how much? 250 you lost as normal, 50 you lost as abnormal. Totally how much you lost? 300. How much is remaining? 4,700. So total units remaining is 4,007. And for 1 unit, how much is the cost? 1052.63. So how much will get absorbed in inventory? 4947, 360. But what was your purchase cost? 50 lakh. In 50 lakh, if you add these two, obviously you will get 50 lakh. If you add, you can add. There could be slight round off errors. That's okay. Don't worry about the 5-10 rupees ka round off error with me, because this is not 63. This is more decimals. So it is okay. Don't fight with me on that. Okay, now. All right. So if you add these two, automatically you will get how much? 50 lakh. So in 50 lakh, this much got absorbed in inventory. This much went off to P&L. This went off to P&L because it is a case of an abnormal loss. Processing time or proceed? Okay. Sir, there is one more concept I think I've written in the chart book. I didn't probably explain that. Again, how should the inventory be valued at? Cost or NRV, whichever is low. How do you find NRV again? Selling price minus selling expense minus further completion cost if any. Is raw material an inventory? Is raw material a type of inventory? So how should that raw material be valued? Same, cost or NRV, whichever is low. Do we sell raw materials? Does the manufacturer sell raw material? How do you find NRV? Selling price minus selling expense. Raw material is never sold. That means you don't know the selling price. If you don't know the selling price, you don't know NRV. If you don't know NRV, you can't value the raw material. Understanding the pain point? To find NRV, we need selling price, but raw material we never sell. Then how do you find NRV of raw material? Okay, so that was a pain point which AS2 said, okay, fine, we understand that. Hence they said link raw material valuation to finished goods. Link the raw material valuation to finished goods. Because from raw material, ultimately, what will you produce? Finished goods only, no? So hence raw material valuation, you link it to finished goods. Meaning, if finished goods is valued at cost, raw material also will straight away get valued at cost. If finished goods gets valued at NRV, raw material also will get valued at NRV. But we don't know NRV of raw material. But if raw material gets exhausted, we will replace it. We will buy it again. So take replacement cost as NRV, substitute. Replacement cost can be substituted as NRV in this particular case. Because once raw material is over, we will buy it again now. So that replacement cost, you can substitute it as NRV. This is a concept. This is also quite popular. We have seen a lot of questions coming in relating to this concept. Can we start? Can we take up some questions on this? Okay. Question number 11 in our study material. I think some examination question only should be. Okay. Check this. Mr. Mehul, one person. They've given some information about inventory, and this information is as on 31st March 2019. His factory produces a product called X using raw material called A. So X is your finished goods, A is your raw material. Okay, Ji. 600 units of raw material, it is purchased at 120 and the replacement cost is 90. Cost is 120, replacement cost is 90. This is for raw material. Okay, let's have that information ready. Don't worry about all this. ICAI will give a lot of blade. They'll put mokka poduvanga. Okay, we don't want all that. Now we don't have time. Okay, we will directly take up the main matter. Raw material ka how many units we have pa? 600. Cost how much? 120. Replacement cost how much? 90. Units is 600. Cost is 120. Replacement cost is 90. Updated. Valuation we'll do separately. First, let's list down the data. We also have partly finished goods. Partly finished goods means WIP. How much? 500. Cost incurred till date is 260. How many units of WIP? 500. How much cost you have already incurred? 260. Okay. That's okay. This units can be finished next year by incurring an additional cost of 60. We'll keep this information a little bit on hold for the time being. 1500 units of finished product XO at a total cost of 320. So finished goods we have 1500. Cost is how much? 320. Selling price of product X. Sir, will you sell raw material, work in progress, or finished goods? So finished goods ka selling price is how much? 300. Okay. Now, sir, for valuing inventory, we need only two components. What are those? Cost, NRV. First, let's value finished goods. Do you know cost of the finished goods? Yes. How much is that? 320. What do we need? NRV. How do you get NRV? Tell me that formula or whatever structure. Expected selling price, which is 300, minus expected selling expense. Selling expense given or not given? No information means it is 0. Minus further completion cost. Sir, further completion cost is 60 rupees. Sir. It's finished goods. Da. Finished goods means you will produce it further or already finished. Already finished. That means what? Is further completion cost relevant for finished goods or only WIP? Only WIP. So what is NRV of finished goods? 300 minus 0, which is what? 300. Correct? Huh? First, let's value this. Finished goods ka cost is 320, NRV is 300. So you will value it at what? Which is lower? 300, which is what? NRV. So you will value finished goods at NRV at what? 300 per unit. How many units you have? 1500. So what will be the total cost? 1500 into 300 will give you 4,50,000. Easy now? Yes, G. We already know finished goods ka valuation means raw material ka valuation anyway is linked to finished goods. If finished goods is valued at NRV, raw material will get valued at RC. Here RC means replacement cost. Yes, no? What is replacement cost? 90. So it will get valued at 90. That's a provision. If finished goods at cost, raw material also at cost. If finished goods at NRV, raw material at replacement cost. Done, Ji? So 1 unit 90, 600 units, how much? These took a multiplication, 54,000. Okay, now last thing remaining is what? WIP. For WIP ka, let's find NRV. How do you get NRV? Expected selling price. Sir, you can't sell WIP, but eventually you will sell finished goods. Finished goods, you will sell it for what price? 300. So expected selling price is how much? 300 minus expected selling expense, how much? 0. Minus further completion cost. Is further completion cost relevant for WIP? Yes. How much you will incur? They only told you. How much is that? It can be finished next year by incurring an additional cost of 60. That is nothing but your further completion cost. So your NRV becomes how much? 240. Yes. So cost of WIP 260, NRV is 240. It will get valued at what? 240. 1 unit will get valued at 240. 500 units, how much? 500 into 240, that will be 1,20,000. So if you add all this, this will be the closing stock that will come in your balance sheet. That's all. Go for the next. Okay, I think I have few more minutes. Maybe I'll take one more question. Lucky for you. Today we'll go on time or maybe a little early. 1:30. 1:30 alla mudiyadada. 2:30 thane we promised. 2:30 only, no. 2:30, before 2:30 we'll finish. Yeah, I think more or less. Okay. What da? What 6 da? 6 o'clock you want me to take a da? Day, my throat will not sustain da. What, you want me to retire today only? Question number 13 in our class notes. So, okay, I think this one. Okay, fine, I will try. Alright, A Limited is engaged in manufacturing of chemical Y. They want to manufacture chemical Y, which is finished goods, using raw material X. More or less similar question, but with 1 or 2 extra fittings. They have given following information on 31st March 2017. Raw material X has the following cost. Cost price is 380. Pay attention to this. Unloading charges. Can we add? Standard says you can add what? Any cost incurred to bring the inventory to present location and condition. Sir, unless you incur loading and unloading charges, will goods come inside your factory? No. Can you add this? Yes. Freight means transportation. Can you add transportation? Only when you pay transportation cost, goods will be delivered to your present location, which is factory. So all these three can we add? Yes. So what is the cost then? 440. The replacement cost is given to be 300 because we need that for valuation. Na? So raw material ka cost you know, replacement cost you know. Now chemical Y is a finished goods. Material consumed is 440. How? Sir, this is raw material, no? Raw material cost also will form part of finished goods, right? And they have added. Material consumed is how much? 440. To make the finished goods, you will only incur material or even labor also. There will be labor, variable production overhead as well as fixed production overhead. Labor cost per unit is 120. Can we add this? Yes. Variable overheads can we add on? Yeah. Sir, I will assume this to be variable selling and distribution overheads. Please don't. In this context, all this you assume it as variable production overheads only. Okay, Ji. So that means can we add this? Yeah, I told you all these three will be added on an actual basis. Meaning how much ever is given, you can straight away add them. This is what is given. This I have written, leave this for the time being. Okay, yes, no, sir. Let's go further. Fixed overhead is how much? 4 lakh. Now this we have a concept. Fixed production overhead, can it be added? Yes. But there is an absorption calculation. What is that? Fixed overhead is absorbed on normal capacity or actual capacity, whichever is higher. Total, how much is a fixed overhead? 4 lakh. What is a normal capacity? 20,000. Sir, all these are cost per unit. If you just check the heading, all these are cost per unit. But this 4 lakh is for 1 unit or total? Total, right? And totally how many units? 20,000. You should not say 20,000. This 20,000 is normal capacity. Now we'll have to write. I have not written it here, but anyway, fixed production overhead should be absorbed based on normal capacity, which is 20,000. Actual capacity given a missing. If it is missing, what do I assume? Normal and actual are same. I don't have any other information. So 4 lakh is a cost for how many units? 20,000. For 1 unit, how much? 4 lakh is a cost for 20,000 units. So for 1 unit, it will be 4 lakh divided by 20,000, which will be 20. Can we add fixed production overheads to inventory valuation? Yes. That's what I here have added for our calculation. Done, Naji. Now adding all this, you will get the cost of finished goods. How much is that? 660. Okay. The closing balance of raw material X was 1000 units, chemical Y was 2400 units. This is the number of units remaining unsold as closing stock. Okay. They are asking us to value closing stock of raw material and finished goods under 2 cases. One, when the NRV of chemical Y is a finished goods. When the finished goods ka NRV is how much? 800. Now we know the concept now, sir. Raw material ka valuation is linked to finished goods. If finished goods is valued at cost, raw material also at cost. If finished goods at NRV, then raw material will be at replacement cost. Now first let's value finished goods. What is the cost of the finished goods? What is the NRV of the finished goods in first case? 800. So finished goods will get valued at what? Finished goods will get valued at NRV. NRV is 800, cost is 660. So finished goods will get valued at cost. In first case, since finished goods is getting valued at cost, raw material also will get valued at cost. Now just simple calculation. How many units we have? Raw material 1000, finished goods 2400. 1000 and 2400. Valuation, both are at cost. No. What is cost of raw material? 440. What is cost of finished goods? 660. Just update that and multiply, you will get the answer. All okay. At the end, balcony, last 2-3 rows. Good. Thumbs up. Okay. Look at the second scenario. In second scenario, NRV is how much? 600. Finished goods ka NRV is 600. Cost is how much? Cost is 660. NRV is only 600. You will value it at cost or NRV, whichever is lower. Which is lower? NRV. So that means in the second case, finished goods is getting valued at NRV. Raw material will get valued at replacement cost. What is NRV of finished goods? 600. What is the replacement cost of raw material? 300. That means the valuation will be 300 and 600. Number of units same, 1000 and 2400. Valuation will be 300 and 600. That is what the basis will be. What cost or replace the NRV. No? For raw material, it will be replacement cost. For finished goods, it will be NRV. Multiply, you will get the answer. No need to write the story. Okay. If any of the RTPs and MTPs may, if you see Blado, Mokka, not required. Just the contents and answer. Or if you feel the marks is on the higher side, you can write the provisions. Or usually what ICAI says is, they will use the word explain, analyze. And that is the time for you to put Blado. Full provision. Not too much also, 4-5 points you write. If they say calculate, then only calculate. So why will suggested answers have pointers? ICAI, in their material, they would also want you to understand how they derived the answer. So they'll also write the provisions. But in exams, you don't have to write that. But if you see the word exam, analyze all this, so you have to put Blado. Otherwise, 2-3 marks go in there. Okay. Now, okay. Maybe this one last one, I think I'll take it up and then, yeah, let's see. Question number 21. I think this is a CA final question. I think it came in CA inter paper once. I think this is from my CA final paper only. Or maybe it is there in CA inter books also. I think, I don't know. Anyway, leave. What the? Last attempt this only came. Then I think no point in doing it. We'll cut. This attempt it will not come. Okay. But anyway, marathon people use for 2-3 attempts. No, so let's do it off. It's okay. But it can come sometimes even that bouncer also ICAI puts. Same question they will repeat also. We have seen ICAI plays with your mind games like anything. Best people for mind games. Okay. Sir, check this. Opening inventory. Finished goods or raw material. They have given kgs. 1000 and 1100. How much is the value? 25,000. 1000 units of opening stock you have. Valuation is 25,000. Raw material you have 1100 units. Total value is 11,000. Now, purchases. Sir, when they give raw material and finished goods, will you purchase finished goods? The moment you have raw material, it is a manufacturer. What will manufacturer purchase? Obviously, raw material. How many units? 10,000 units. At what price? 1 lakh. That means for 1 unit, how much? 1 lakh for 10,000 units. So 1 unit, how much? 1 lakh divided by 10,000, which is 10,000, right? No, 10 per unit, I think. I wrote ulta. Yes, no? 10 per unit. Correct, no, sir. Okay. Now, there's one small concept involved here. I'll maybe tell in a bit. Labor cost can you add? Maybe I'll ask this. Labor cost can you add to inventory valuation? Labor cost can be added. Sir, conversion cost has 4 components. Tell me what are those? Material, labor, variable production overhead, fixed production overhead. Yes, sir. So labor cost can we add? Yes. They're simply asking us to value the inventory. Okay. So labor, whatever is a straight cost, I will add. Labor cost can we add? Yes. Here, this is the cost, and I have taken assets. So why have we not taken purchase of raw material? There is a small concept. I'll tell you in a bit. Fixed overheads can we add? Yes. Straight away, or there is a calculation. What calculation is that? Fixed production overheads are absorbed based on normal capacity or actual capacity, whichever is higher. So I can't add this straight away. Let this be on hold. Remaining is on sales. So some closing stock they have given. Okay. All right. Expected production was how much? 15,000. This is your normal capacity. Normally you expect to produce how much? 15,000. But actual maybe a little less also. So this is your normal capacity, 15,000 of finished goods. But due to the fall in market demand, the selling price of the finished goods was only 20 per kg. Each unit of finished goods, you can only sell it for 20 rupees per unit. Replacement cost of raw material is 9.5 per unit. Now you're supposed to valuation. Okay. Now, sir, this you need to be a little careful. Yes, purchase cost of raw material can you add? Raw material purchase cost can be add for inventory valuation. Yes, but now you tell me, if I purchase material worth 1 lakh, is it necessary I have to use all my material for producing the goods? No, I may use little or I may store a little also. So for production, we want material purchased or material consumed? We always want material consumed. Yes, no, because for finished goods, you want to use the materials. Correct, no? So when we say in conversion cost, I gave you the heading there, no? It is not material cost, it is a material consumed. Usually they won't give breakup. But here when they give you this breakup and all, you will be able to find material consumed. How? How do you get COGS, sir? You have done all this, no? Cost of goods sold. Same work. Opening stock plus purchases minus closing stock. Check. What is the opening, excuse me, what is the opening stock of raw material? 1100. How much did you purchase? 10,000. How much is the closing stock of raw material? 900. Add these two and deduct 900. How much are you getting? 10,200. What is that 10,200? Raw material consumed. Yes, no? Raw material consumed. So this much you have consumed. And for per 1 unit, how much is raw material cost? You already found out that. 10 per unit. Yes, no? Correct. Now here 1 lakh divided by 10,000 if you do, you will get 10 per unit. So for 1 unit, the cost is 10. For 10,200 material consumed, how much is the total raw material consumed ka value? 1 lakh 2,000. So you should not add 1 lakh to your finished goods valuation. Rather, you should add what? 1 lakh 2,000. That's what the number they've taken here. So why you didn't do this in previous question? In previous question, you know, this data will not be given to you in the question. If the data is given, then only you will be able to find out raw material consumed. Otherwise, you assume that raw material purchased and raw material consumed are same. But if this unit breakup is given, first always find what's the raw material consumed, which is this, and then do its valuation. Need a minute for this? That was quick. Fine, sir. You're saying yes, I'll move on. So raw material you have added 1 lakh 2,000. Labor may, is there any drama or straightforward? Straightforward. This is done. But there is one drama around fixed production overhead. Okay. Again, concept is fixed production overhead should be absorbed on normal or actual, whichever is higher. Normally, how much you expect to produce? 15,000. That's your normal capacity. Given. It is given in the question. Yes, no. Actual capacity. Though not given, we can find out. Though not directly given, we can find out. How? Very simple. Yes. How much? What did you say? Okay, I'll try this. See if you are also trying to say the same thing. Sir, how much? Sir, you will sell raw material or you'll only sell finished goods? Finished goods. How many units did you sell? 10,000. Take a calculator. You have sold 10,000 units of finished goods. And you still have how many units of finished goods as closing stock? 1,200. Sir, if you want to sell 10,000 and if you want to keep 1,200, at least that much you need to produce, no? Correct, no? Without production, can you sell? No. First, you have to produce and then only you will be able to sell. You have sold 10,000 and you have kept 1,200 aside. That means how much you must have produced? 11,200. Yes, sir. But hang on, there is also opening stock. How much? You already had 1,000. That means how much did you actually produce in the current year? How much did you actually produce in the current year? 10,000 plus 1,200 minus 1,000. Did you understand? Everyone, that's what you have to do it there. That's what I've done here also. How much are you getting? 10,000. Easy. Everyone good? Once more or got it? Pakka. That side, this side, every side okay? Okay, so that means totally you have produced in the current year, the actual capacity how much? 10,200. Fine, now you got your normal also, you got your actual also. So normal is 15, actual is 10,200. Fixed production overhead should be absorbed based on normal or actual, whichever is higher. These two you compare, which is higher? 15,000. That means for absorption purpose, for fixed overhead absorption purpose, the units will be considered as 15,000 units. How much is your total fixed overheads given? 75,000. 75,000 is for 1 unit or total? For total units for absorption purposes, how much? 15,000. So 75,000 is a cost for 15,000 units. For 1 unit, how much? First find that. How much is it? 5 per unit or 5 per kg. Till here we have solved. Are we okay? Are we okay? Once more. Okay? Excuse me. Sir, how many finished goods did you actually produce? 10,000. You actually produced only 10,200 And for 1 unit, how much fixed overhead will be absorbed? 1 unit of finished goods will absorb a fixed overhead of 5. How much did you produce? 10,200. So what is the total fixed overhead that will get absorbed? 10,200 into 5. How much is it? 10,200 into 5. How much is that? 51,000. But how much did you incur? How much fixed overhead did you incur? 75,000. So in 75, 51 has got absorbed, means some portion has not got absorbed. That will go off to P&L. Unabsorbed fixed production overhead will go off to P&L. In fact, I had given you a calculator example during COVID time. This is a loss basically. This is like an abnormal loss. It has to go off to P&L. I'll not go behind the logic of this, which we have explained in regular class by the way, but just say. But so far, are we okay with at least the numerical calculations of this? Everyone good, 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 good. So how much will be absorbed by inventory? 51,000. So you can add 51,000 for your valuation. This is your raw material consumed. This is your labor cost. This is fixed overheads absorbed. Adding all this, you will get the total cost. How much is that? 2,29,500. This is for 1 unit for full. How many units did you actually produce of finished goods? 10,200. So total cost to produce 10,200 is 2,29,500. So for 1 unit, how much? 22.5. So why are you finding per unit? They've given the selling price in total or unit? Unit. Okay. So check here. Last conclusion statement. What is the cost per unit of finished goods? 22.5. How should it be valued at? How should the inventory be valued at? Cost or NRV, whichever is low. How do you get NRV of finished goods? Expected selling price 20 minus expected selling expense, not given, 0. Finished goods can't have further completion cost. So what is the NRV of finished goods? 20. Cost is 22.5. NRV is 20. So how is finished goods getting valued? 20. What is that 20? NRV. So that means the conclusion is this. If finished goods is getting valued at NRV, raw material also will get valued at replacement cost. Now can we put up the final valuation? So how many units of finished goods you have as closing stock? 1,200. What is the NRV of finished goods? 20. So 1,200 into 20 if you do, you will get finished goods valuation to be 24,000. How many units of closing stock of raw material you have? 900. What is the replacement cost of raw material? 9.5. 1 unit 9.5. For 900 units, how much? 900 into 9.5, which is 855. Adding these two, you will get the total closing stock, which will appear in your balance sheet. Okay, that's it. All right, thank you.